Neil, right? He's the founder and CEO of Voltage Digital Media. He's been launching, operating, and growing private e-commerce business for almost 10 years. He and his clients have sold over $100 million in physical products. So,
wow.
Yeah, we'll have his contact information in the show notes. Enjoy this episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Neil, welcome back, man. We are excited to have you, and we're looking forward to today's topic. But before we dive into it, man, we just had you on recently. And before we get to today's topic, if you could maybe give us a little overview. Last time you talked to us about kind of building an online business. Take it from there.
Yeah, man. Thank you so much. So it was a fun episode. If we got the time correct, somewhere back in May, end of May, roughly, we had a great episode to talk about building e-commerce companies.
Yeah.
How to do it in a reasonable amount of time. How to stack the profits correctly in that business over expected results. And we talked about how to build a brand, and then we extrapolated into what is the business, what I call the platinum principle. The business behind the economics of e-com, and building something with the end in mind. So that business has an intrinsic value, it has worth, it has an exit potential. So we're not just building a side hustle for fun and for just profit. We're building a business that has intrinsic value that'll be worth more in the end when we sell it than any time during the business building phase. So we really went into that detail and helped kind of unpack that, and we'll probably try to do that a little bit more today and talk about what it means to sell that business. We'll call this the Ashley Madison side hustle business, as we were joking. How to get your little piece on the side with ecom. If you're too tired to do this, or you're not inspired, this might not be the episode for you. But that's kind of the stuff we're going to dig in today, right?
No, that's a good way to start, Neil. Good way to start.
Good.
Absolutely. So Neil, the reason that we've got you back so soon is because there's some opportunities that are presenting themselves kind of in this space. If you could, man, start us off there, kind of give us the big overall view of what's really happening in your space and where these opportunities are coming about.
Yep. So for those who may not be familiar with the e-com space as much, maybe you're working a job, you're in a corporate thing, or maybe you're off in real estate investing or IBCs or playing around in the other markets or whatever. For the e-com world, the growth has been huge. In the last 3-4 years, due to the COVID bump, and then due to the adoption requirement of online purchasing versus physically going to the stores, that has increased the mechanisms a lot by which people who would normally not get online are now getting online, got comfortable with the concept of delivery in 1 hour to 2 days with products, and started to realize, wow, there's another world of opportunity that I really wasn't privy to. And I like that convenience. And so it's got new growth projections that are showing new $1 trillion in opportunity in e-com, and one of the fastest growing business models really out there for all kinds of reasons. The other aspect that you alluded to, Cameron, is changes in the market right now through, obviously capitulation of certain events that are occurring in our space, or real estate or other events that are occurring that are allowing certain models to take opportunity and preference over others. And one of the big things you alluded to, I'll unpack a little here, was the SPAC-driven acquisition model that occurred in the last less than 30 months now, in which SPACs, or special purpose acquisition companies, were formed for investor capital, alternative to Wall Street investment strategies, in which they wanted to put buying dollars into e-com companies, and they went specifically after Amazon FBA business model. And they deployed somewhere around $12 to $15 billion in acquisitions to do that. One of the major hurdles they discovered as they placed people with great knowledge and degrees and other really cool acronyms into was that they didn't know how to operate these. And so one of the major gotcha points that happened in the last 6 months is that they had to stop acquisitions because they couldn't keep the SPAC above a certain performance or profitability because they were acquiring too fast without understanding how to operate the business. And I have been consulting and stopped consulting most recently with a couple of companies who simply didn't want to listen to me anymore, which is fun. Because they didn't want me to tell them to give their capital back, because that was the end result. Either learn how to operate this company correctly, or save yourself the embarrassment by simply giving the money back to your investors. So the end result is they didn't know how to purchase what they were doing. They bought some really dumb brands. They were going downhill very rapidly. And their answer was, well, we got more capital to spend. At which point I said, no, you probably don't. If you've got a fiduciary responsibility to your investors, you might want to rethink that. So what's going to happen is those products that are the businesses within those SPACs are going to be dumped. The CFO I'm sure, behind CEO direction to honor the agreement to their investors and their performance of those portfolios, are going to find a line across the bottom of the balance sheet and just dump what's on the bottom half. There are good products. There are good brands. They were acquired because they were profitable. Okay. The problem is the operators made them less profitable. So they fell below certain lines in the balance sheet. So they're going to end up on the market as a fire sale, which is presenting a new pipeline very quickly of small business opportunities, 25, 50,000 to a $5 million range that have a lot of upside potential and opportunity. They're just looking for the right operator to actually take advantage of that opportunity. So as we originally talked, and to wrap that around, we talked about building CEO operators, those who understand operations and capacity, but don't necessarily have the knowledge to properly execute the operations of an e-commerce company, which is one of the things we help train people through so that they become very astute in the financial and fiduciary responsibilities of managing one of these kinds of companies, especially if you haven't done it. So the gotcha, the pros and cons, and I'm sure we're going to go into this a little bit more, is understanding, well, if I just buy an e-com company because it's profitable now, doesn't necessarily mean in 6 months it's going to stay profitable if I don't know what I'm doing. And if I don't know what I'm doing and I hire someone else to take over management because I say I don't have the time, and they start to drive it into the ground, then what happens to the asset that I just had, right? I don't know how to recover it. I don't know how to replace the operator. I don't really know exactly what they were doing. And I may have split profits with them, so now it's even more hairy. You see where this? So there's some of these things we can dig into that I'm sure are on the minds of anybody who might be considering starting or buying one of these kinds of business models.
Who do you think is going to be considering buying these? Is there somebody with a certain skill set or a background that this might be better suited for?
Well, I mean, we're looking at acquiring them because we have the operator experience and knowledge to run one of these on scale. Others are looking at it as potentially passive income. Now, define passive because this word gets tossed around so much. What I would refer to it closer as almost automated income. So if I run something for 10 to 15 hours a week and it's tossing off 10 to 100,000 a month in profit, I consider that to be pretty almost automated income. But I have to understand in that 10 hours what I'm actually doing to impact revenue, what we call RGAs, or revenue generating activities that I'm actually doing to maintain or gain on the investment and the type I'm doing, which means you have to kind of understand the whole model. And if you're not really comfortable with it, you have some very detrimental strengths and weaknesses you're not identifying correctly. So those who want to acquire this must first acquire the knowledge. You can't just simply acquire the business.
Okay, so how do we acquire the knowledge?
Well, hopefully this podcast is giving you some of that, giving you some insights, okay, as to where your boundaries might be. I know it sounds really cool to own an e-commerce company, and it is when you know what you're doing, and it tosses off very good profit. I mean, we're earning more in our physical asset-driven e-commerce companies than I would ever put money into Wall Street for on continuous earns that I have more control and management over than just dumping it into to Wall Street. I have the ability to return 10 to 15% profit on my money every year and can even increase that or take it back faster by exiting certain brands. And I have the control mechanisms to do that as opposed to handing it to a fund manager or some sort of investment account that does that. So I'm not privy to that, and I'll be transparent. I'm not in the Wall Street game, right? I have none of those assets and no 401ks. All of my money is wrapped in physical products and asset-driven business models. So to gain that knowledge first is to accept the differences in that investment strategy, right? First up, I have to know that I got the chops for it. I got to know that I'm willing to learn, and this is something I'm really actually wanting to do, and not just because it's cool. It might be a fad, or I can tell people I have an online business, because that quickly could change to an online dumpster fire. So what you want to make sure you understand is the fundamentals of business of e-com. All right. And we can oversimplify that at times by saying simple things like, well, you create a brand and you put products in it and you sell it to people. Okay, great. That's really, that's really simple. I got it. But what do I sell? Like, what the heck do I actually sell somebody that makes money? And suddenly things get a little more dependent, a little more complex, and a little bit more ambiguous if you don't understand. So the first knowledge acquisition is understanding the fundamentals of management and making money in the business model. Second is understanding the product or product-driven business cycle of an e-commerce company. And third, it's understanding the value of those things to the person that you're selling to the avatar, the consumer of that product. You get those three things right, and the mechanics can be taught to assistants. I have no employees. I have people with SOPs and OKRs that do the activities of my business. That gives me a lifestyle-driven business right? Not a business that drives my lifestyle. There's probably a few people who have great lifestyles because of the business they work for, or the business that they created that gives them that lifestyle. The difference is that freedom of time, the freedom of activity that a lifestyle driven business gives you, in which you apply the business fundamentals to the lifestyle you want to grow and keep the business in control so the lifestyle does not subject itself to that. Does that make sense?
Yeah, absolutely.